What's going on, guys? I think it's time for a little talk. Just lately, all my videos have really just been on stock market, crypto market. Everyone's hyper focused on it, and myself included. I think for a reason, which we're going to get into in this video. On this channel, I am planning on doing a lot of videos just on like building a business, which I have built from scratch, me and my wife. So there will be more videos on that in the future, but I feel like we're just in a moment in time. A lot of people are kind of sensing it. Craziness is going on. I was doing my morning reading today, and a quote struck me as being incredibly true at this moment in time. JP Morgan: nothing so undermines your financial judgment as the sight of your neighbor getting rich. Couple of factors going on: the increase in social media usage, stimulus checks, people gambling on Robinhood. It's just a confluence of factors that is, a lot of people are sitting at home watching other people get rich. I mean, they might not even be getting rich. They are at least, though, giving off the impression that they're getting incredibly rich by trading stocks online. It does start messing with your head, and then you go out and you're like, oh, they're doing it. Why can't I do it? This is how manias and bubbles begin, and actually how they end also. That's mostly what I'm worried about. In my last few videos, I've kind of alluded to my thoughts on this, that we are definitely in bubble territory. I'm just going to say it now, though. For sure a bubble. I'm nervous. I'm not like actively buying stocks. I am buying specific sectors of stocks, which maybe I'll touch on a little bit at the end. But don't listen to me. I don't know what I'm doing. Not financial advice. I'm just, sensing some stuff that's going on that I've sensed a few times before, where I was actually more caught up in it. I didn't realize I was just, kind of a useful idiot at the time. Like the dot-com bubble is a great example. I was way younger, but I didn't realize like what was going on. I was just like, oh, things are really different this time. There's all these dot-com stocks. This is totally new. Of course, the price, the old valuation metrics don't make sense. They always make sense. It always matters what you pay for something. That's really the thing that matters most. And there is this phenomenon going on a lot now where like Tesla, for example, it dropped about 9% yesterday. I was just scrolling through Twitter. I use it as like a social sentiment indicator a lot of the time, which good or bad, it is kind of anecdotal. But then I see a lot of posts on like, this could be your chance to own an amazing business at bargain basement prices. And it's just using, relative valuation, because the prices are nowhere near bargain basement. The only way you could say the prices are bargain basement is if you're basing it on what the price was a few days ago. So it's relative valuation. Objectively, still a very expensive stock. I always kind of check in on the TikTok investors, Twitter. I think it's the best social sentiment indicator. And man, this one the other day really struck me as like we're so close to the top of the market that, this just really exemplifies it. There's another saying, the market can remain irrational longer than you can remain solvent. So like a good example is in the dot-com bubble, which I'm really referencing a lot because I think there's a lot of similarities. The market was crazy overvalued, and then it doubled in the next 6 months before the big crash. So like things can get really crazy. If they're crazy right now, they can get 10 times crazier. It's just, for me, I'm just going to be sitting on the sidelines mostly. And I'm fine with that. Some people, they really have trouble with that because they get caught up, which is kind of the point of this video. You get caught up in like, oh man, my neighbor bought Tesla at 100. Now it's at 800. Maybe I should buy at 800. Why can't it double? A lot of that goes into Bitcoin too. A lot of people just think it only goes up. It goes down very fast also. So just be cautious. And that's the main thing, guys. Be cautious, because I make these videos and a lot of people watch these videos. They come from my other channel, which is just like a nutrition channel. And they're commenting and they say, I'm just getting into stocks. This is really exciting. And the psychology, you have to start thinking, why are you just getting into stocks? Is that the sign of something? There's a reason you're now just getting into stocks when you were never into stocks before. There's probably a lot of people like you, and that is usually the sign: high retail participation in the beginning of the end. That's just where my mind is at. Could be totally wrong. But here is the video, guys, that I was just like, what is happening? I don't know if I can actually play the audio because it's just a song. So I'm just going to sort of narrate this. We're selling our $500,000 home to invest in stock. $350K will go towards stock. We will rent for a year. I'm going to miss our theater room the most. We've only been investing in stocks since COVID hit. Our goal is to get to 1 million. Can we do it? I pray we don't lose everything or else I'm going to choke my husband. So of course, just next level greed. You have a home with a theater in it and you're selling it to gamble in the stock market. How does that make sense? It's emblematic of a lot of sort of the sentiment that's out there right now. You are going to sell your home and put your money in a place that is competing against people that all they do all day, 24/7, teams of analysts are analyzing stocks. And you're thinking you have an edge over those people and you're going to beat them. That's what you're saying. When it comes down to it, there's another person on the other end of every trade you're making, probably smarter than you if you just started investing when COVID hit. Just the height of lunacy. Also, just like not really understanding how things work at all, because the odds are if you turn your 350K into $1 million in the stock market, your home price probably would have just appreciated a lot also with no risk. Then you're going to rent for a year. I mean, you're probably throwing like 20 to 30K down the drain just in rental costs. This is the thing. When you start seeing your neighbors making tons of money, maybe you've even seen a little bit of success, you start thinking risk, taking extremely risky steps and measures is normal. It's sort of like a mob mentality. To this couple, this probably seems like a totally rational idea because you're so caught up with the mob of speculative investing. Just because everyone out there for the last, since COVID happened, has been making a lot of money because the market has only gone up. None of these people have experienced the market going down. So just remember that. Anyone could have made money over the last 9 months. What matters is that you're developing a repeatable skill. So if you can make money over the long term, 5-10 years, and you have this like system down that you know that you can rely on to consistently make money, even when things are going down, oh, my system works. These filters I use, this idea, this way of thinking has been proven. I believe that it works over the long term. Because if you're just throwing your money in and, it randomly goes up, it's not repeatable. You have no confidence in the strategy actually working. So when things go bad, what do? You start questioning your strategy. Do I even know what I'm doing? Sell everything. That's why most people, they buy high, they sell low. I would say these people that are selling their house probably doing the same thing because we're at a high right now and you're buying. I mean, it could keep going up. So I don't know what I'm talking about. Some things that you can use to just, if you're maybe new, you want a good place to start. Here's some things you can look at and just get like free screeners delivered to your email. There's 2 books here. There's Deep Value by Tobias Carlyle. He also has a book that's a little bit shorter and easier to understand. It's called The Acquirer's Multiple. Really good book. Pick that up on Amazon if you're interested in stocks. It's like maybe $15. This book is like $75 and you're probably just better off with that one. And then there's this one, You Can Be a Stock Market Genius, Joel Greenblatt. And this one came first. This one was published, I think, in the early 2000s, maybe the late 90s. And then this one uses what's talked about in this book and takes it kind of to another level. But the general premise of both of them is the same. You have just a fundamental ratio that you're looking for, and you filter out all stocks and you indiscriminately buy stocks that fit that filter. Is that what you should do? I don't know. You got to make your decisions yourself, but to me it at least gives you a universe of stocks to look at and maybe be interested in. And you're looking for cheap stuff, of course. So you're not going to find stocks in these screeners like Tesla, like Peloton, none of the high flying stocks. These are all cheap stocks that you're going to look at and be like, I don't really want to own that stock. That's the reason you do want to own it, because everyone looks at it and has that reaction and they mean revert over time. That's kind of the whole premise of these. You can go to acquirersmultiple.com and you just have to sign up. It's free. Don't do the paid thing. It costs tons of money. Just do the free filter, the free large cap 1000 screener. And every quarter, which is every 3 months, it delivers, I think, 30 results or 50. Yeah, 30 results. The acquirer's multiple is EV to EBIT. And that is what Tobias refers to it as. And he has a whole book explaining why you would want to pick stocks from this list. And then you can also go to Magic Formula Investing. This is a little bit more of a minimal website here. So the Magic Formula is it's more complex than the acquirer's multiple. It uses which I'm sharing on screen right now. It uses the earnings yield, and then it also uses return on capital, which are 2 metrics you can look up for businesses. It's basically cheap companies that are giving high return on capital. This is the list here. Here's some stuff you can look at. So as you can see, it's a lot of stuff that you'd probably be like, I don't like the looks of that. It's gross companies, but that's the point. So like AMC, you know, obviously movie theaters not doing great. You got Buckle, which is a retailer. I usually go through the list, and there's some that I'm just like, I'm not really messing with that. Like AMC, I wouldn't mess with just because of all the speculative mania that hit it recently. Buckle, I'm pretty averse to retailers like that. So, you know, I have my own implicit biases that go into this. But what you'll learn, and if you actually read about psychology and market psychology, is you're actually better off not giving your input into the system. It actually makes the results worse. So if you go through and look at these and you're like, oh yeah, that one looks bad. I don't like the looks of that. I don't like this industry. You're making your returns worse, because the reason you don't like the industry is probably the reason the stock is cheap and why it's going to do well in the future. The acquirer's multiple is even less, because in this book, he shows why there's less filters on it, because he shows why you don't actually need the return on invested capital. You just need EV to EBIT. That's the ratio you're looking for. It actually performs better. So that is Tobias's whole thing, and he's the author of this book, and I listened to his podcast. He's really good. I would highly recommend listening to the Acquirer's podcast. Just anything Tobias Carlisle does is really good stuff. Some similar companies, couple I own on here. I own a lot of the gold mining stocks just because I'm like a pretty bullish on gold in the medium to long term. Altria I own. I look at Tobias's list a lot, and I will get ideas from it. Neither of these I use and I just, you know, no thought buy them all. That's not what I do, but a lot of people do that, and it does work. It's back tested to work pretty well. Even like Tobias will say, like, a lot of the times these his filter is going to return like a lot of mining companies. Sometimes he'll just remove all the mining companies and buy the others. So it's just a good place to start, you know. I think it kind of centers you when you're looking at all these high-flying stocks and you're like, dang, that stock's up 400x in the past 2 years. Like, why couldn't I have been in on that? It's not a healthy mindset to be thinking like that. You just got to be trying to maximize your returns without what people don't consider is without a lot of risk. Risk-adjusted returns is what actually matters. So when your neighbor is selling their house and putting $350K into the stock market and buying Tesla, when things go their way and they get their 10x, they have a really good return. But what was the risk they're taking? The risk is they don't have a place to live. They're living in their car. They got 2 kids, you know, like that's not a risk you should be comfortable with taking. So you're looking for risk-adjusted returns. Maybe things go really bad for you. You lose like 30, 40%, you know, you're still fine though. That's more of an acceptable risk-adjusted return than potentially 10xing or being homeless. Like, you know, it's just people are getting caught up in this speculative mania. It's starting to scare me. I'm just making this video so hopefully you guys don't fall victim to this, because man, it could go on for a while longer, and it's going to be tough to sit there and be like, every day Bitcoin's going up, Tesla's going up, you know, etc. It's tough. Sometimes you just got to sit on the sideline. Doing nothing oftentimes is the best decision. For full transparency, not that you guys need to follow what I'm doing. I don't know what I'm doing. Since I do have a lot of Bitcoin, I have over the past few days been selling a little bit. Let's say 20% of my Bitcoin holdings I've been putting into gold stocks, gold miners. I've even put some into a gold crypto, which is a gold-backed crypto. So you're not betting on crypto anymore. You're really just betting on the gold price appreciation. Because to me, I'm kind of looking around. What's cheap? What do I believe in? Where can I put money? Because I don't really just want to have a bunch of, you know, US dollars. I don't want to have a bunch of expensive stocks. So when I look at, you know, what's cheap, what's really falling, what's climbing, where am I comfortable putting money? To me, really, gold is kind of like the standout deal right now, just for the way my mind works. So the main thing I'm thinking, which a lot of people out there right now are not thinking, is reducing risk. Yes, it's awesome to make a lot of money. It's also awesome not to lose money. You know, sometimes just staying in the game is really the most valuable, because when you start to sort of, you know, expand your time horizon, and we're really thinking big picture here, there's a mania in electric vehicles. There's a mania in a lot of speculative tech stocks. If we really think big picture, hey, let's just stay in the game. These things are going to come back around. If I really believe in the technology for the next 20 years, like a lot of people are saying, there's going to be a better buying opportunity than right now. That's just a fact. So, you know, having a little bit of patience, thinking big picture. We're not thinking make money fast. We're thinking make money slow, long money. It accumulates over time, compounds over time. We're going to be in this game for a long time, right? So you don't need to make a lot of money now. You just need to not lose money right now. That, I think, is probably the most important thing you can look for. So when I'm looking for that, it's really easy for me to put money into gold, put it into a few select stocks that are just defensive. One other thing, guys, maybe a good place to look. If you are really interested in stocks, I know a lot of you are just getting into this. There's this group of guys, they have this fund. It's called Horizon Kinetics. They have been right about so much. I've been following them for probably the last 7 years. They know what they're doing. Unquestionably. So I think what you could do if you're interested is just listen to some of their past market commentaries. They do one every quarter, and you know, they've been into Bitcoin for 5-6 years before anyone on Wall Street was into it. They have a huge investment in this company called Texas Pacific Land and Trust, which has like 10x'd over the past few years. And they're big on inflation. They think inflation is coming. I tend to agree. They have some ETFs, and this is just how you can get investment ideas. So they have this inflation beneficiaries ETF, and it shows you exactly what's in it. You can just go on the exchange and buy the fund if you want. I don't like to do that just because the expense ratio really eats into your returns. I like to look through, see what they're holding, just like a mental exercise to look through some of these companies and figure out why do they benefit from inflation. So for example, timber companies, lumber prices go up, land is more valuable when inflation starts to hit. So that's, you know, a pretty self-explanatory one. There's some in here that I don't really fully understand why they're beneficiaries of inflation, so it helps me learn. And it also just gives me, you know, a list of stocks to look into and potentially invest in. When I am a believer in the theme of inflation coming, I do think that's where we're headed. I don't know though, so I like to, you know, have some sort of contingency set up, but I do think this is a good place to look for ideas. Another good place to look for ideas is Whale Wisdom. You can search for your favorite hedge funds and stuff. Like, I really like Bill Ackman, Pershing Square. So here is Pershing Square Capital, really concentrated. Here's his holdings. So I'm a big holder of Howard Hughes Corporation. I've had that one for a while. I don't own any of these other ones, but it's just, you know, a good place to look. You can see the recent changes since the last filing. So he's buying Howard Hughes. He's kind of slowly selling a few of these, probably just because they've run up so much. Yeah, just good place to look. Look for ideas. You know what's a bad place to look for ideas? On YouTube and TikTok. So just try thinking for yourself, having some differentiated thinking, you know, not just like, oh, Tesla's going up, buy Tesla. You know, you got to think of the downside. This is a long video. I wanted to make it a short one, but that's just what's running through my mind right now, guys. I would be hyper-focused on risk reduction as opposed to profit maximization at this stage. I think that's what matters. Thanks for watching, guys.